Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. This is Your Money, Your Wealth on Talk Radio 760 KFMB. Now, here's Joe Anderson and Big Al Clopine.
Welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here, certified financial planner. Alan Clopine next to me. He's a CPA. Thanks for tuning in. Markets, almost 19,000, bud.
Yeah, we're getting a little Trump bounce, I guess, is what some people are calling it. Can you believe the press? I mean, 2 weeks ago it was the markets are going to collapse if Trump wins, and now we're getting the Trump bounce.
So bad. Hey, speaking of investments.
Yes.
What do you think about dividend-paying stocks?
Well, that's a good question, Joe, because right now...
Let's ask a CPA.
Ask a CPA about an investment vehicle and see what you get. However, it's a good question because...
You have an article.
Yields, yeah. I got some help. You set me up perfectly until you just blew me up. Anyway, I mean, how many times have you heard people come into our office and say, Joe, Al, I'm gonna get some high dividend paying stocks because you can't get any yield on your savings accounts and the bonds, they're not paying enough, but these high dividend stocks I can make a good income and yet they still can go up in value.
Sure.
I mean, we hear this all the time.
And I think it's a good strategy to have dividend paying stocks, but it's also good to have other types of stocks. So I think the problem lies is when you just concentrate on one area. And I think still to this day, most don't understand that when the dividend is paid, the stock price falls by that amount. I was teaching a class, Maricosta College, and I knew this gentleman was all about dividend-paying stocks.
Sure.
And I'm like, sure, yeah, that's a great strategy. However, you don't want to discount other types of stocks.
Right.
I want a globally diversified portfolio. I want dividend-paying stocks. I want non-dividend-paying stocks. I want small companies. I want large. I want mid-size. I want value. I want growth. I want international. I want, right? And he's kind of with his arms are folded, right? And I'm like, oh, God, I know where this is going. And then I went through this whole tax thing too, right? About how the Roth IRA works. Okay. And I spent an hour about how the Roth IRA works. And then I get into the investments, right? Here, this is certain investments. This is how they work. And then he raises his hand because he's grouchy Gary. He's like, well, if I put dividend-paying stocks in my Roth, is the dividend tax-free? Yes. We just spent an hour and a half talking about the
it's tax-free, everything.
Yes, so then I'm like, all right, well, the guy's a dividend-paying. So then I said, okay, well, here's a strategy that a lot of people are using, which there's pros and cons to it, right? So it's just wide open. It's just an educational setting. I'm like, if you have a portfolio full of dividend-paying stocks, which is great, you might get the dividend. However, the stock price reduces its value by the dividend. And then he goes, well, not my stocks.
not mine.
Not mine. Are you sure about that? I was like, no, I'm lying to you. I like to make things up about dividend-paying stocks. He's like, well, mine don't. I was like, well, do you reinvest your dividend?
Right.
Yeah. I'm like, okay, well, then the market value is probably when you get the dividend and then you reinvest it. So the stock price goes down, but then you bought another share.
Right.
So your market value will probably be the same, but your share price, did you look at your share price? The share price goes down by the same amount of the dividend. And so my point was that you could create a synthetic type of dividend. You can sell like a share of a mutual fund or an exchange-traded fund or an index fund to create that same dividend. And then he's like, well, mine doesn't. I'm like, well, you got to think about this. If I'm given a dividend, that means there's capital coming out of the company. Right? It's not a coupon payment. It's not an interest payment. It's not a bond. It's a stock. You're an owner of the company. They're distributing some of the cash back to you. Of course, the stock price has to go down.
Right.
But
Yeah, Joe, and a lot of people don't really understand that. And that's one of the 6 reasons why it's not necessarily the best idea to focus solely on dividend-paying stocks. And in fact, if you have a company that doesn't pay dividends, you're not paying taxes as you go. With dividend-paying stocks, you're paying taxes as you go.
Right, you're reinvesting the dividend. You don't necessarily
right.
notice anything, but at the end, you get the 1099 of a dividend, right? So then you have to pay tax on it.
And you're paying taxes on it. So here's a few other things. One is historic performance, and I know you can pick probably any time period. I just happen to have in front of me, this is the last 10 years according to Morningstar, and they have their own composite averages. The Morningstar dividend leaders earned a little over 6% over the 10-year period ending October 31st of 16, and the Morningstar dividend composite was about 7. I'm rounding. Everything else was higher. Those were the 2 lowest performing asset classes.
Why do you think that is?
Well, it's because everyone is trying to buy dividend stocks, and so it's pushing the price up so they're not good values, which is another one of the 6 reasons.
Oh, is it?
Right? But, you look at mid-value, so it's about 7 3/4. You get up to large core, 8%, and mid-core is over 8%. Now, 6% to 8% may not sound like a lot, but compounded year after year after year, that makes a big difference in your portfolio.
What's the time frame on that?
10 years.
All right. Well, the next 10 years could be a little bit different.
It could be
of
different,
course.
yeah.
Sure.
And I'm not saying that's the only reason you ought to think about it, but one of the things is what we call performance chasing. We're just kind of getting into that, and the gist of this is over time, investors who buy and hold long-term investments, specifically low-cost index funds, earn even more than investors chasing the latest investment trend. So if you're only thinking of investing in one thing like dividends, trust me, when this is the article, when I say everyone and their grandma is doing it, and it's true, everyone's talking about getting into dividend stocks. And so what does that mean? It's only a matter of time that the dividend stock prices go up because of the demand.
It's supply and demand,
Supply
right?
and
The more
demand.
people that are buying, what happens to the price? It increases.
Right. Joe, another thing is diversification. We all talk about diversification. Don't put all your eggs in one basket. And this is the same thing with dividends. It's a type of asset class. It's a type of company that's paying dividends, but they tend to be more, would you agree, Joe, more value type companies as a whole? Not always, but in many cases, the growth companies, high growth companies like Apple and other ones like that, they either pay really low dividends or not too many dividends at all. So you're getting a certain asset class, which is great. But I want you to have all the asset classes. I want you to have small companies, mid companies, large companies.
But if you look at the composite, though, too, let's say of value companies, and it depends on how you want to define value. We look at it from a book to market ratio, right? So but it's more of a value play for dividends, and we're a value type company. We love value stocks. We love small company stocks. We tilt our portfolios towards those particular asset classes because if you combine those asset classes over time, I guess history suggests that you'll have a higher expected return just because of the risk component within those types of stocks. So.
Yes, yeah, and so we got maybe a couple of minutes left, but another thing I want to go over, and this is kind of related to what we've been talking about, is the cost. And on average, we all know that you want to buy low and sell high, and it just goes to reason that a certain asset class that everybody wants is going to be priced more high. And that's exactly what's going on with dividend-paying stocks right now. And then when you look at some of the cost ratios, for example, this is just an example. I mean, you could probably find another one that goes the other way, but this is what's in this article. The iShares Core S&P Total Stock Market ETF expense ratio is 0.03. 3 basis points, 3/100ths of a percentage point. And yet the iShares Select Dividend ETF expense ratio is 0.39, 39 basis points, or roughly 13 times more expensive. In other words, the internal costs inside of these funds and these two as a comparison is more expensive. And part of the reason why it's more expensive is that there has to be a little bit more of a team of people picking these stocks. And you know what? They're not cheap. There's analysts, there's stock pickers, and you got to pay for them somehow. And those costs, even though you don't pay for them what seems directly, but you kind of do, because it reduces the rate of return inside the fund.
Got to take another break. Show's called Your Money or Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back. Welcome back to the show. Show's called Your Money or Wealth. Joe Anderson, certified financial planner. I'm with Alan Clopine. He's a CPA. Loving every minute of the show today.
You are, or I am?
I am.
Our listeners are.
And now it is my favorite time of the show because it is the Question Corner, Al. That's our new segment title.
Question Corner.
Yeah.
Okay, cue the new music.
Yes.
Do-do-do-do-do-do-do.
It is. This is where we answer email questions. Right?
Okay.
Some good email questions this week.
Got some good ones?
I'm saying that hypothetically because I have not read one of them.
Well, I know I haven't seen them, so I'm trusting you, Joseph.
So I have my list, and then of course Megan has, or Miken has hers, and I'm not going to go with Miken's because I don't really like her questions.
Yeah, you said the same thing last week.
I know she didn't get. She must not listen to the show.
We're seeing a trend here.
Okay. Can I claim a loss? All right, from my Roth IRA. This is to you, Al.
Okay.
All right, I have a Roth IRA open for over 10 years now.
Okay.
I have contributed about $15,000, but I lost around 80% of it due to some stocks that I invested in. Can I claim this 80% loss in my tax return? I know that I can claim up to $3,000 for capital losses in regular investment, but can I claim my losses in the Roth IRA when I withdraw the money? Also, the stock I own is under a lawsuit. I own 100 shares and bought it around $14 a share when it's at its peak. Now the share is only $1.
$1. Oh boy. Well, I'm sorry to say the answer is no. You cannot take a loss in a Roth IRA. It's a special kind of retirement account where neither the income, dividends, principal growth is taxable, but the same works if you lose money, it's not deductible. It's an account that really is not taxed either direction, and that's unfortunate because when you have a Roth IRA and you diligently put money into that Roth IRA, you want this thing to grow because all future income growth principal is tax-free.
Now, I know there's something that you can claim a small loss on an IRA.
Yeah, there is. I wasn't going to go there because she said this. She had been doing it for 10 years. But if you put in a Roth contribution, and I think it's within a year's time. If it goes down in value and you pull that out, you can take a miscellaneous itemized deduction. Yeah, there's something like that. But in this case, it's seasoned money. No, unfortunately, and that's why it's really important to make sure you're investing properly. And so instead of picking a stock or two or three that can go way up or way down, as in this particular case, why not pick an asset class that is like a small value ETF or index fund?
Here's what I would say to this. And I think it depends on your net worth. It depends on how much assets that you have, and it depends on how savvy you are as an investor. If I want to take a bet on something, right? So let's say that I have a decent-sized portfolio, and maybe I want to take 5%, 3% of that portfolio, and maybe play some bets, right? It sounds like this was a pretty small startup type of company that blew up, or so it could have gone gangbusters, or so maybe you put $10,000 and you see what happens, right? Because if it blows up, that's in a Roth IRA, that's going to be all tax-free for you. And if it blows up on this side, right, on the flip side, well, then you lose. So you got to be careful, and I think I agree with you on the conservative side because it's very difficult. Well, it's not very difficult, but there's limitations to get money into a Roth, right?
Right.
So if I make too much money, I can't do a direct contribution. I can do conversions, but then I have to pay tax on it. So there's a lot of work around the smart strategy to get money into a tax-free position. The last thing that you want to do in most cases is take an absorbent amount of risk in that account where it could go to zero here.
Yeah, so in this example, I think that, is it she? She, he, neither?
It's Pat.
Pat, it could be either.
It's Pat.
We'll say it's she. So if she's under 50, she would have been putting $5,500 per year into this Roth if she was max funding it. So that's $55,000, and it sounds like at one point maybe it was up at $100,000. So, but it sounds like, Joe, it was all pretty speculative. And so I'm going to actually agree with what you just said, which is if you want to take a small piece of this and place a bet, it's kind of like gambling, right? But make that 2, 3, 4, 5%, maybe even 10%, but probably no more than 10% of your portfolio to take this kind of gambling type bet on.
Yeah, and you have to have some. I think about if the money's going to be gone, it's not going to hurt your overall strategy.
Right. In other words, you can afford to lose it.
Yes. I mean, if you lose it,
it's not going to affect your
It's not going to.
situation.
Yeah, you're right. Your overall financial strategy is not. You're not. Rice and beans.
Okay.
All right.
Okay. Next.
Okay. All right.
Is this next one from Pat also?
Yeah. This is. Yeah. From Pat. I was recently told by more than one financial advisor that I should roll my employee retirement plan, now that I've left the company, into an individual IRA. When I called that company to do just that, I was told by their advisor not to roll it over.
Okay.
He explained that I began investing in 2007, 2008 when the market was low. If I were to roll over to an individual IRA, I would be buying in when market prices are high, thus buying fewer stocks, bonds, whatever prices comprise the plan. He also said, since your plan has averaged a 5.1% gain this year, why would I want to lose that? Makes sense? Can someone speak for this logic for not rolling over? We got to take a break. The show's called Your Money, Your Wealth.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Welcome back to the program. Show's called Your Money, Your Wealth. Couple of things. Let's start with the advisor saying, hey, sir or ma'am, Pat,
Okay.
roll your money over. You left the employer, roll it over. Okay? Now, there's pros and cons of rolling over a 401k plan into an IRA. The pro is that, all right, well, here, if you have an advisor that you trust, that you have an overall organized strategy, it probably makes sense to roll it over, have that individual or their team manage your overall assets for you to create the income, to do tax loss harvesting, to do conversions and everything else. So that's a positive. The negative is that there's going to be cost involved with that. So if you're working with an advisor, you have to take a look at the cost of your internal plan, and you have to take a look at the cost and fees of what's going to happen if you roll it over. And now, if those costs or fees justify the value that you're getting, then I think it makes sense. If I keep the money in the plan, all right, if I separate from service at age 55, there is no 10% penalty, so it might make sense to keep it in the plan. If you really love the investments and you don't want to deal with it, keep it in the plan. But I can't take loans from it. I can't contribute to it. It's a dormant plan, right? So those are the pros and cons. Anything else on that?
Yeah, another thing is if you're older, like let's say you are you're in your early 70s and you want to get another job, or you want to get a part-time job that has a 401k that you qualify for, you can actually potentially roll that old plan into your new plan, and then you don't actually have to take a required minimum distribution because you're an active participant in a 401k. Yet, if you leave it in the old 401k and or you roll it to an IRA, you have to take a required minimum distribution at age 70 and a half.
So in an IRA, you have the breadth of all investments,
It's also easier, Joe, to do Roth conversions and recharacterizations.
Yeah, you have
in
a little
an
bit more
IRA.
control.
Yes.
Because if it comes from a 401k and you convert, it's going to convert in cash. If I have it in an IRA and if I convert, I can convert like shares.
Yes.
Right. So there's pros and cons. You just have to weigh those out.
Yeah.
Let's assume that she says, yes, I think it makes sense for me to roll just to consolidate, to keep it easy and everything else.
Okay.
Now, her plan advisor is a total D-bag.
He was probably even worse than the other ones.
Awful. So let's just break this down. So he's telling this person, hey, you started investing in 2007 and 2008 when the market was low. If you were to roll it over into an individual IRA, you're going to be buying high. Oh, my God. I don't even know where to start with
I
that.
don't know how to start with that either, because all the stocks, shares, mutual funds, whatever she owns, she bought low and are high right now.
Right now.
And so if you're going to get it out of the 401k, those are going to be sold at a high value, and that transfers over to your IRA. You can buy those same shares if you want to.
At the same price.
At the same price. Right?
It's at the same price. You sell if he's like, how does he know it's high? I mean, the market can still go up another 30%. Who knows? He doesn't have a crystal ball. I'm selling at this share price. I'm buying back in potentially at the same share price.
And that 5% you made this year, well, you're selling those shares at that high price.
Right.
And then
it doesn't go away.
Transfer to the IRA, and you can buy and have the same positions, or maybe even better positions. Joe, like you said, that is a huge advantage of IRAs, is you have a bigger choice of investments.
I would be buying when the market is high. That's buying fewer stocks. No, you're not. He also said, since your plan is average 5.5% gain, why would I want to lose that? What? You're not going to lose the gain. You already have it. It's like, well, if you move your assets, I'm going to take that 5.5% gain back.
That goes in my pocket.
That goes in my pocket, right?
So, Joe, why would the plan advisor want her to keep the assets?
Because I guarantee. Well, there's no guarantees in life. I'm assuming she works for a small company.
Yeah.
Right? And the small company hired an advisor to set up the 401k plan. So the advisor, right, he probably comes in and says, hey, how's everything doing? How's the 401k? Right? It's probably with a loaded mutual fund or maybe an insurance company or something like that, where that individual is getting compensated. And this is probably a fairly high loaded, fee-driven plan. Right? And so if those assets leave the plan, his or her compensation goes with it.
So, all right. So he or she gets a pay cut when they lose assets.
Right. No, you don't want to. Why would you want to do that? You're going to be buying low? I mean, right? It's like you're going to lose your 5.5% gain. Well, this is what really drives me nuts about the profession, is that there's just dirty people that it's like, are you kidding me? Just be honest. Just say, you know what? I don't want to lose your business. Here's what.
Yeah,
if you're going to roll into an IRA, hey, maybe we can do something a little bit different here. Yeah. How can I keep your business?
Exactly, Joe. That's that.
Instead of these lies.
I mean, this advisor must have been staying up late at night trying to think, what could I possibly say to pull the wool over her?
You know what? It's probably not even that. That's what he's been saying for years. Well, here's some plan. I got this notice that she wants to roll over the 401k. I'm going to sit down with her and tell her the same spiel. Wait a minute, you got in the plan in 07, 08. If you get out now, why are you're going to...
You have to buy high.
You got to buy high. I'm selling high, buying high, if that's the vernacular you want to use.
Oh, geez. Yeah, so it goes both directions. So I guess part of the moral of this story is you got to look and see what's in it for the advisor that you're talking to, and know that there's probably a bias there, and just go into it with your eyes open.
Right. There's pros and cons to moving money into an IRA
really
from
are.
a 401k.
And
I would imagine, get the heck out of this plan, because who's ever running the plan is being deceitful.
I would agree with that, but make sure you find an advisor that's, I would suggest fee only, that doesn't sell any products, that really is acting as a fiduciary in your best interest, and then you can start getting better advice than clearly this plan administrator is giving you.
Right. It's just BS. It's all right. Well, so I guess my advice is, get out of that plan but I want to reiterate the pros and cons.
Okay. Yes. Good
Pro
idea.
to keeping it into a plan. So for those of you that are thinking, hey, should I move this out of the 401k plan? Well, if you work for a large company, this is probably a smaller company. If you work for a large company, just understand the costs and fees that you're paying, because you're probably getting institutional type pricing there.
Yeah, so it could be cheaper.
It could be a lot
IRA.
cheaper, right? If you go on your own, retail investor probably gets a little bit, higher pricing than a big institution. It's the law of large numbers. If I like the plan, and you don't have to move the money out of the plan if you don't want to, right? But just know it's a dormant plan now. You can't combine any other plans to that, because you're no longer an employee there. You can't take a loan. You can't contribute. And then the money is still with the company, right? It's still with the plan. So in most cases, in my opinion, I think it makes sense to roll it over. And I know, that could be very biased, because our company is an asset manager, right? We manage assets, and we are a financial planning firm. So sure, if those people roll money to our care, we're going to be compensated on it. So, but there's pros and cons. As long as you understand the pros and cons, you make a well-informed decision to make sure that you're doing everything appropriately for you and your family.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner. I'm with Big Al Clopine. He's a CPA. Thanks for tuning in. Go to purefinancial.com. Learn more about us. We're a fee-only registered investment advisor right here in Southern California. We're at that time of the show where we're asking or reading email questions. Here's one for you, buddy.
Okay, what do you got?
Are profits from trading options in a non-qualified brokerage account subject to FICA tax?
Oh, that's an interesting question. Is that it, or you got more?
No, it says, are profits from trading options or stocks in a non-qualified brokerage account subject to the 10.4% FICA tax?
10.4. Okay, well.
I took that out just not to confuse people.
Well, let me answer that. A couple of different things, I guess. Trading options, no. Generally, that's investment income. That would be, it could be short-term, it could be long-term. Now, if you are classified as a trader, and there's an IRS term for what a trader is, then yes, it would. It could be considered ordinary income, subject to self-employment tax. But for most of us, we're not necessarily traders, and so that's just going to be investment gains, investment losses. It could be long-term gains. It could be long-term or short-term gains, whatever. Now, and the second part of this is when it comes to FICA taxes, if you are a professional trader, then you have to pay self-employment tax, which is actually twice as much as what the rest of us pay in terms of being employed. And the reason it's twice as much is when we are an employee, the employer pays half of our tax and we pay half. So it's 7.65% each. And so when you're self-employed, it's 15.3%. So that's the rate, not 10.3 or whatever was said. If it's
10.4.
10.4. It's 15.3 until you get to about $120,000 of income, and then the Social Security, the FICA part goes away, and now you're left with a 2.9% tax. But generally, no. Trading options would be investment income, not subject to FICA tax.
Here's one. Big Al, love the show. My wife and I
was going to say your mom wrote that, but no. Okay.
Yeah. My wife and I are both 60 years old. We have taxable investments valued at $900,000.
Okay.
401k and IRAs valued at $1.2 million, and a Roth valued at $23,000.
Okay.
We would like to retire in about 8 years.
Okay.
A coworker said he heard you on the radio.
Oh,
and
wow.
said that it was possible to pay no income tax in retirement, even on Social Security benefits. With my situation, how is this possible?
It's probably not possible because you know what? You've done such a good job saving. You've got $900,000 in a taxable account, $1.2 million in 401ks, IRAs. Congrats. About $23,000 in a Roth IRA. If you're going to work, you're 60, you're going to work 8 more years till 68. You've got a couple years where maybe your income is lower. That would be the prime time maybe to do Roth conversions, and maybe you want to be doing some conversions right now. You got
Here's how he does it, all right? He's got to convert the $1.2 million into a Roth IRA from now till, let's say, age 70.
Yes.
He pushes out Social Security to age 70, okay? Then he's got his brokerage account of $900,000. Maybe he saves X amount of dollars into that brokerage account, right?
Right.
So now he's got, I don't know, whatever, $1 million plus in the brokerage account. The 1.2, hopefully most of that, maybe let's say he could get 2/3 of it into a Roth, right? Pay the tax now, get 2/3 of it into a Roth over the next 10 years. He's got 10 years to do it. You with me?
Yes.
All right. So now.
So he does like $100,000 per year.
Something
Roth
like
conversion.
that, right?
Give or take.
Yeah, of course you have to do more planning here. But now most of the assets are in a Roth IRA. He's got a little bit left in the IRA and then his Social Security, because then it's based on provisional income. And if he does tax loss harvesting, right? So if he's very tax efficient with the non-qualified account, the one that the brokerage account, if he could then, have losses and gains and he offsets those, that's not going to show up on his tax return, right? Then you look at the Roth IRA, that's not going to show up on his tax return. And then you push out your Social Security to age 70. Looks like he's a fairly high income wage earner. That's probably be pretty high, Right? So he could.
He could do it.
That's how you do it. I mean, that's what we've been doing with our clients for years, is trying to get as much money into a Roth IRA as possible, and pushing out Social Security, because you have to look at how Social Security is going to be taxed, and how they look at it is on provisional income. And he's got so much money in a retirement account, it's going to blow him up.
Yeah, it is, Joe. The tough part about that is he's going to be working for the next 8 years and probably will already be in a high bracket. So so that's how he could do it. Would we recommend it? Probably not, because the taxes he would pay now to do that may not justify the complete tax savings on the other end. But it is possible. You could also take the $900,000 and start investing in real estate, and then when you retire, you become a real estate professional, and so you can deduct all your depreciation losses, and that's another way to pay virtually no tax. Our President-elect Donald Trump, that's what he has done. Completely legitimate, completely legal. Now, but in terms of your fact pattern, it would be difficult. I'll just be honest. It would be difficult to get that much converted to where you're paying no tax, and maybe you don't even want to, because if you're paying 25 or 28% federal tax to convert and staying out of the 15% bracket, or maybe the future 12% bracket, that may not make sense. It might make a lot more sense to figure out, all right, how much should I convert so I can stay to the top of the 12 or 15% tax bracket? So I'm paying 25, 28% tax right now to be able to do this, but that keeps me out of the higher brackets later. Yes, I am paying some tax, but I'm staying in the lowest of brackets. That actually would be the smartest tax strategy.
Boring.
Well, yours was unrealistic.
What are you talking about?
It's too expensive. You were going hypothetically. You can do that, is right. It's just not going to make sense. I don't believe.
Well, let's pencil this thing out. Well, we don't know how much he makes.
I know. We don't know it near enough yet. Because that's to do this properly, you got to do tax projections from now till into your 80s or 90s, right, to figure out what's going to make the most sense for you.
So let's say if he did that, Alan, all right?
Yeah.
And so if he lives until age 90, all right, so 20 years. So he retires at 70, retires at 90, and assume he doesn't pay a dime in tax for 20 years.
Right.
All right. Then you would have to look at how much money did he pay in tax by doing my strategy to age 70 versus how much he would have paid, right? Because you paid all the tax up front before retirement, and then in retirement you don't pay a dime in tax. Tax-free forever.
Yeah, you'd have to, to do this right, you'd have to do tax projections and look at present value of dollars. And yeah, I agree. It is a way to do it. And I guess that was the question. How is this possible? And you are correct, Mr. Joe Anderson. It is possible to convert all of the Roth IRA over the next 10 years, so there is no required distribution.
Well, let's say if he's saying, hey, you know what, I'm going to stop working.
Sure.
Well, then you convert.
That makes it easier, right? Because now you're in a low tax bracket. And that's a big miss, Joe. A lot of people retire at 62 or 64. They're in a very low bracket, and they could be doing Roth conversions all the way up to age 70 and a half, and then be in a much better spot. In some cases, pay very little or even no tax. And boy, it was a good question, Joe. And we're talking about Roth IRAs, converting 401ks, IRAs to Roth IRAs, and truly it can potentially save you thousands of dollars in taxes. Plus, there's a number of other benefits that really aren't offered by your IRA or 401k. For example, when you convert your retirement accounts to a Roth IRA, you get tax-free income in retirement. There are no required minimum distributions, and you can pass along the money in your Roth IRA to your beneficiaries tax-free.